Imagine I handed you a $100 bill right now. You would probably buy dinner, a pair of shoes, or a few online purchases you'll completely forget about by next week. But that exact same $100 can grow into hundreds of thousands, even over $1 million. It happens entirely through a specific mathematical principle that creates more wealth for ordinary people than almost any other strategy. Curious? Look at this timeline comparing two different investors. On the top, we have Sarah. She starts at age 20, putting away just $100 a month. She does this for 10 years, and at age 30, she stops completely. On the bottom is Mike. He doesn't start until age 30. He also puts away $100 a month, but he keeps adding to it every single month for the next 35 years until his retirement. By age 65, who ends up with more money? Basic logic suggests Mike wins easily. He contributed his own cash for over 3 decades, while Sarah only contributed for 1. Here is the final output. Sarah wins. Her final balance dwarfs Mike's total. She gave her money the single most valuable variable in investing, a variable Mike could never buy back: time. People often assume their primary obstacle to wealth is a low salary. The math shows the far greater danger is waiting too long to start the clock on the money you already have. What Sarah utilized is called compound interest. In simple terms, you earn a return on your original investment, and then you earn returns on those returns. Think of it like planting a sapling. For the first year or two, the visible growth is agonizingly slow. Eventually, the tree grows branches. Then those branches grow their own branches. The expansion accelerates in a fractal pattern until it towers over the original seed. Money scales in the exact same way. Historically, the broad United States stock market has served as the arena where this compounding happens over long periods. Past performance will never guarantee future results, but over multiple generations, holding a diversified basket of American businesses has consistently functioned as a reliable engine for building wealth. This chart projects a historical average return of around 10%. Notice what happens when you invest $100 a month. For the first 10 years, the line crawls almost perfectly flat. By year 10, you have about $20,000. We extend the timeline to year 30, and the math starts doing the heavy lifting. The curve bends aggressively upward, reaching roughly $200,000. By year 40, the line shoots almost completely vertical, crossing $500,000. The final 10 years of this timeline generate more raw wealth than the first 30 years combined. Time transforms idle cash into a self-replicating asset. That's exactly why successful investors will tell you the first decade is the hardest. The massive gains arrive at the end. You might be wondering why you shouldn't just keep that $100 safe in a regular checking or savings account. The reason is inflation, a hidden pressure that quietly drains your purchasing power over time. This visual tracks a $100 bill over 30 years. At a standard 3% annual inflation rate, the cost of goods doubles roughly every 2 decades. That red overlay is your actual buying power shrinking year after year. Your $100 is still mathematically $100, but it buys a fraction of the groceries it used to. Buying productive assets, like a low-cost stock index fund, is a defensive necessity. You invest to ensure your money grows faster than the rising cost of living. Leaving all your cash untouched in a bank account feels entirely safe, but mathematically, over a long time horizon, it guarantees you will lose money. If the math is this straightforward, the obvious question is why everyone isn't doing it. The true obstacle is procrastination. Look closely at this 40-year compound interest curve one more time. People delay investing because they tell themselves they'll start when they get a raise or when the timing feels perfect. But when you start 5 years late, you aren't cutting off the tiny, slow years at the beginning of the timeline. You are slicing off the massive vertical years at the very end. The beginner's blueprint is simple. Build an emergency fund for unexpected crises. Pay off high-interest debt like credit cards. Then put that first $100 into low-cost diversified index funds, which are simply single investments that hold small pieces of hundreds of top companies. Markets will drop. They always have. But panic selling locks in your losses. A consistent time horizon consistently outperforms trying to perfectly time your entry and exit points. Building wealth requires a permanent shift in how you view your cash. Stop looking at your money merely as a tool to consume things. Every single dollar you own is an employee. You have a choice in how you deploy them. You can hire an employee to work a single day to buy you a nice dinner, or you can invest them, sending them out to work 24 hours a day, 7 days a week for the next 40 years. Your first $100 will not make you a millionaire by next month, but establishing the habit of starting early provides a mathematical advantage no salary can easily match. If you found this video helpful, subscribe to Money Moves Mastery. Share this with someone who keeps waiting for the perfect time to start investing. Small discipline and long-term thinking build wealth. Start the clock.